Hello, everyone. So today I'm back with a brand new class. So today we have Business Studies Cambridge A2. We had this class yesterday, but as you know, we had technical difficulties. And I came to know last night that it was not just only me, it was everyone. So there were a lot of technical difficulties. Internet was slow. My class got stuck in the middle. Probably that's the problem with technology. But today I'm back. I'm going to repeat the class what I did yesterday because I'm not satisfied. I want to have an uninterrupted class. And there you go. So we will start again because yesterday we had a lot of important concepts. So I want the students to know and learn them properly. Because there was interruption, I could not concentrate properly. So, anyways, let's go ahead. Business Studies Cambridge A2 chapter. I think it's 20 marketing planning. Okay, and we are in the last bit. Today is the final day of this chapter. This is a very long chapter, and I promise today we are going to finish it, right? So there we go. So yesterday I started with this picture. Yes. So this is a picture of someone predicting your future. Yes, astrology. Now, astrology is predicting your future, your career. It can be your marriage life. It can be your relationship with anyone. And they do astrology. Astrologers do or perform astrology on the basis of position of moon, various other planets like Venus, Jupiter, Saturn. They calculate all of them, the sun and the moon, and then they predict your future, your career, your marriage, your relationship, and it can be anything, right? Now, why am I talking about astrology? Because if you know your future, things will be easy for you. Yes, you can plan out the way you want. Let's say if you're not going to have a good career in teaching profession, then you will not go for that. You will choose something instead. So it will help you to plan out. It'll help you to think ahead. It'll help you to avoid problems. Yes. Now, similarly, if you could predict things in business, if you could predict the sales or predict profit or predict your accounts, it would be great. Yes, you could solve a lot of problem. You could avoid a lot of mistakes. Yes, hires up. So there you go. So is there a way? Can you predict your sales? Yes, there is a way. So there is something called sales forecasting. There is a way. And marketing managers, they are able to predict. And I will tell you how. But if you predict, it'll help you to actually know how many units to produce. Because the problem is, if you make more items, let's say I want to sell this remote. Now, if I make 500 of these, and if I just sell only 100 of these units, then it's a problem. I will waste money. Yes. And I'm not better in planning. So predicting helps you. It'll help you how many units to produce. Yes, the number may not be exact, but it'll save you from overproducing, because if you overproduce, you will waste money, and you don't want to do that. Same with astrology. If you predict, it'll help you in your future. It'll help you to do things that are good for you and not bad for you. So similarly, in sales forecasting, if you forecast, you can make the exact number of units, even if it's not exact, near about. Okay, it'll help you to have an appropriate level of staff, because you don't want to have too many staff. Because think about it, having too many staff means you have to pay them a lot. And paying them a lot means your profit level will decrease. You are wasting. So you need to have an appropriate level of staff. Okay? It'll help you to better manage your finance, sales forecasting, how much to invest, how much not to invest. So predicting always helps. It always help you to think ahead instead of just sitting back and thinking about the present. In business, you always need to think ahead. In business, you always need to think about the future. Okay, so sales forecasting is something real. Sales forecasting exists and we can predict, just like astrology. I don't believe in astrology, but there is something called astrology, right? That's why I am, comparing both of them. You also have account forecasting, finance. You can also do that in finance. Now, how can you do sales forecasting? There are four ways that we talked about. Okay, let's start. Now, look at this picture. So this man is a retailer. A retailer means a person who sells things in a shop. It can be anything. It can be cap. It can be shoes. As we can see from the picture, probably this is a shoe and a cap store. So this is a retailer, and this is a cap supplier. Now, this person is hired, let's say, by your factory that makes caps. Now, this person meets the retailer on a regular basis, yes, to distribute caps. Now, when you meet this person, you are exposed to valuable information about customers, that what customer likes and does not like. Yes, what is the latest market trend? What is going to happen? What sells most? What doesn't sell? And you can take all those information. You can go back to your factory and tell them that, look, red caps are not selling well, so blue caps are best selling. So let's make more of those items instead of wasting resources on red caps, right? Okay. Or let's say product A does not work well, product C works well. So you will make more of product C instead of making product A, because product A consumes a lot of resources and you want to avoid wastage, because the idea is always to maximize profit. Okay. So like this, suppliers are always exposed to valuable information from different individuals. And you can collect all those information together and take it to your factory, take it to your company and use it. And this method is known as sales force composite. The sales force, the salesmen, they regularly meet the suppliers, not the end customers, but suppliers. They're also regarded as customers, not direct, probably indirect. And you can use those valuable information, because retailers have valuable information about customers, about people, about market trends, what is selling good, what is selling bad, what are the future prospects, what they should do, what they shouldn't do. Okay, so that is Salesforce Composite, right? So that's the first thing. Now, the definition is given here. Please read the definition. I will email you the slide today. The second is, think about this. This is let's say a reality show, and this is a judge in a reality show. Now, in this method is known as the Delphi method. In Delphi method, you have a panel of experts, a panel of judge. They're anonymous to each other. They don't know each other. Okay, and there will be a facilitator. Okay, someone who will give them questions, someone who will give them certain questions about the market. So the panel of judge will receive the questions and they will fill out the questions. Now there may be 4, there may be 5. They don't know each other. It's anonymous, and these judges are very experienced. They're outside from the business. They're external judges. Okay, they're not employed by the business. Remember, now they're very they're skilled. Their knowledge. Let's say they have been in the business for 15, 20 years. Okay, and they know about the market. So you can use them. You can use this expert panelist to predict the demand in the market. Okay, and you can give them a set of questionnaires. You can make questionnaires and you can give it out to them. They will fill it out and give it out to you again. and repeat this process 3 4 times, multiple times. Now the big question is, why do you want to do multiple times? Why not just once? Now you want to repeat the process 4 5 times. You want to give them the same set of questions 4 5 times, because our mind always changes. That's the problem with humans. Like, my mind always changes. I want to do different things. So when you give the same set of questions 4 5 times, the answers may also change, and you want to see that change, and you want to balance it out, because you don't want to have extreme opinion like yes and no. That's an extreme opinion. One set of questions says yes, and the other set of questions says no. So that is extreme. You want to balance it out. So you want to have 3 4 times, and if this person changes the mind, it's fine. You can see them. Okay, and then you can judge yourself. So that's the Delphi method. Okay, you will have a panel of experts. One thing you have to know: it is employed out of the business. They're not a part of the business. They're experts. They're very knowledgeable. They may be celebrity. They may be entrepreneurs. They have been in the business for 15, 20 years. Okay, and they don't know each other. They're anonymous. And then there will be a facilitator who will give them the questions. And the same set of questions is repeated 3 4 times or multiple times, to balance out extreme opinions. Okay, because the panelists may change their mind after the first round. In the second round, they may think of something else, and you want to know that. Okay, so that's the Delphi method. Okay, so it is a long range qualitative forecasting. Qualitative forecasting means you want to know their perceptions. Write it down. You want to know their in-depth perceptions. Okay, in-depth knowledge. Why are they doing it? So that's a second way. That's a second method. So we talked about Salesforce Composite, and then we talked about the Delphi method. If you have any questions, please write it down here. We're doing very good today. We don't have any internet issues. Everything is fixed. So yeah. Then let's go ahead. We're done with this. So yeah, it takes several rounds of questions, as I told you. And why do you want to do several rounds multiple times? Because you want to balance out extreme responses. Okay. Now look at this. Okay, look at this. Now this is a set of questions that you may get from different companies. This is from Netflix, and look at the questions. Okay, selection of Netflix original movies produced by Netflix. 1 is not at all satisfied. 7 is extremely satisfied. Put them, and this is how they they collect your opinion. They collect your perception. Now, what kind of survey is this? Is it qualitative? Is it quantitative? Okay. I feel this is qualitative, the second one. This is quantitative, the first one. Quantitative because, it tells you about the numbers that this many people are satisfied, they're extremely satisfied, or they're moderately satisfied. Quantitative means numbers. It has to do with numbers. Quantity, numbers. It'll always tell you how much, how many people like this movie, how many people liked this jeans, how many people liked this, coffee cup or coffee mug. So it always has to do with numbers. That's quantitative analysis. Okay, so in research, you can do quantitative analysis, and we've done this in market research. Now, you can also do qualitative analysis. Qualitative analysis means, okay, you like this movie, or 75 people liked this show produced by Netflix, but I want to know why. So qualitative answers the whys and hows. Okay, whys and hows, and it collects your in-depth perceptions. Okay, quantitative analysis is more. Okay, just give me 1 minute. I want to just shut off my Facebook. Really sorry for that. Okay. Quantitative analysis will always be represented by graphs and charts. Let me show you. There we go. It's always represented by graphs and charts and pie charts and line graphs. See the different kinds of graphs. Quantitative analysis can be represented by graphs because it has to do with numbers. But whereas qualitative analysis, you have to write down, you have to explain why did they like this movie. Okay. So this is called consumer survey. So you go to your consumers, you go to your target users, those who use your product or will be using your product, and give them a set of questions. Okay, it can be questions of quantitative, which relates to quantitative analysis. It can also be qualitative, and it can be both. Okay, so you collect the raw data. So when you give them a set of questions, they'll fill it out. That's the raw data. When you cook something, when you cook meat, you get the raw meat, right? And then you cook it and you process it into cooked meat. So similarly, you get the raw data first, and then you cook it up. You process the data. Okay. Quantitative analysis will be in terms of graphs, in terms of figures, in terms of charts, but qualitative will be written texts like this. Okay, simple. Why, how, you write it, you explain it properly. Okay, so there you go. So that's consumer surveys, okay? And it can be quantitative, it can be qualitative, it can be both. It's very good because you have direct touch with your consumers, with your customers, and you know their perception, you know their point of view directly. Okay, so that's very good in a way. Okay, yeah, but the two problems with consumer surveys is, write it down, it's very time consuming. If you carry out by yourself, there are different agencies. Now, consumer surveys can be also be conducted by different market agencies. Okay, marketing agencies, they can do it for you. They will charge you some amount of money. But either ways, it's very time consuming. Number one, time consuming. Write it down. Number one, time consuming. The second one is it's very expensive. It's very, very expensive. It's also complex. That's the third problem. Expensive because you have to employ a lot of people. You have to make questionnaires properly. You need proper researchers. People need to go out, collect the questionnaires, process the data, represent them properly. So these are the three problems. It is expensive, it is time consuming, it is also a complex process. Okay, there we go. Then you have jury of experts. It's the same as the Delphi method, but there is only one difference. In the jury of experts, the panelists, the experts are hired within the business. Probably they're high-ranked officers, probably they're placed at the top of the hierarchy, and they have worked in the company for 15, 20 years. Again, they're very experienced, but they're employed by the business. Okay, so that is jury of experts. Now, these are the four ways you can predict your sales, right? Salesforce Composite, where you have direct, where you have direct contact with your supplier, with the retailers, and you take those information. Okay, then the Delphi method, you hire people from outside, and they will predict your demand. You do multiple rounds, and then you have consumer surveys. That's number three, and then number four is jury of experts. Okay. If you have any questions, please write it down here because we're going to the next topic. Okay, we're going to the next topic, right? Before we go on to the next topic, let me see if we have any questions here. Just give me a minute. I'm going to check out. Right, we don't have any questions, so we will go ahead. Now, there we go. Now, if you look at this image, this is a t-shirt store. Okay. Now, a t-shirt store may have different, let's say, different life cycles. Now, in t-shirt store, some t-shirts may have a trend. Like nowadays, everybody wears round neck t-shirts, slim t-shirts. So that's the underlying trend of the market. Okay, like people will follow a certain trend. That's what it is. Then you will have seasonal fluctuations. Okay, t-shirts are will be very popular. You will sell a lot during summer. Okay, it'll go up. And again, let's say during winter, people does not wear half sleeve t-shirt. People will wear long sleeve t-shirt. Therefore, the sales of half sleeve t-shirt will come down. These are seasonal fluctuation. You will also have cyclical fluctuation. Cyclical fluctuations are very common. It happens in all business. Oscillations, it goes up and down, up and down. Sometimes the business is good, sometimes it's bad. You also have random fluctuations. Let's say because of COVID-19, all of a sudden there's a situation and you don't have anything to do, right? Um, and there may be a situation like recession. So you can also predict the sales using this four technique, knowing the trend. Okay, what's the current trend in the market? What are the seasonal fluctuations in the t-shirt market or in the market that you're in? Um, if you know the cyclical fluctuations and if you know random fluctuations, so this will help you to predict the sales, and therefore you will make units according to that. Let's say the trend is, let's say every month you're selling 500 units of t-shirt, but all of a sudden there'll be a seasonal fluctuation because in winter half sleeve the sales of half sleeve t-shirt is very less. Yes, so you will not make 500 t-shirts, probably you'll make 200. You'll come down, and this will help you to save money. But then again, summer will come, and then you will produce more. So these things will help you to predict the sales. Okay. um, so yeah, and this is known as moving averages. Okay, it moves continuously. Now, if we go ahead, the definitions are given here, and if we look at the definitions a little bit, it's the underlying movement in a time series, the current trend that goes in the market, seasonal fluctuation that happens in 12 months, right? The sales will be different during Christmas, during Eid, summer or winter, cyclical fluctuations that happens in all businesses. Sometimes the business is good, sometimes it's bad. And then you have random fluctuations. Okay, special emergency situation because of poor weather or negative public image, right? There we go. So moving averages, let's say in a year there are 4 quarters: January, February, March, that's the first quarter. Then April, May, June, that's the second quarter. July, August, September, that's the third quarter. And then October, November, December, that's the fourth quarter. Let's say you take your sales every month, 20, 30, 50, 10. You add them up, you get 110. You divide by 4, because in this case, they have taken 4 quarters. You divide by 4, the 4 quarter moving average is 27.5. So simple, yeah? Now, if you want to find the trend, look at this graph. If you want to find the trend, these are the sales of the 4 quarters in 2011. So this is 2011. And 4 quarters, look at the mouse, and 120, 140, 190, 130. You add them up, you get 580. Then in this for the second calculation, you leave 120. You leave one number from the top. You leave one number from the top, and then you include 140, 190, 130, and one number from 2012 first quarter. Now, why are you leaving one number? Because you want to have updated figure. We know this is from 2011. So what you could have done is, what other calculation does is 2011 dhore na. They'll leave everything and they'll just start calculating from 2012. But they are considering 2011 because they want to have an updated number. Okay, they want to have an updated number. So they left just one calculation from the first quarter. They just left one number, and they took 140, 190, 130, and then, of course, they took one number from 2012. You have to take four numbers because there's a 4-quarter moving total. It'll tell you in the question, and it'll be 590. When you add 580 and 590, it'll be 170, and 170 divided by 8, because you've taken four numbers here and four numbers there, divide by 8. And then you get 146.25. This is your trend. That's how you do again. Again, you add 190, 130, 130, 160. Then you leave 190, and then you do 130, 130, 160, 220. And then you add those two numbers, and you get this one. That's how you do it. Okay? It's simple, but it's lengthy. So that's how you get the trend. The trend tells you what's the trend in the market. Okay? So there we go. Now, if you want to know the seasonal variation, it's very simple. Column 3, write it down. Sales revenue, column 3, 190 minus 146.25 is seasonal variation. There you go. You get 43.75. Column 3, which is sales revenue, minus this 146, you get 43.75. Right? Then if you look at this calculation, so this is 130 minus 150. That's minus 20. Minus means, there is a minus figure. Sales did not exceed. It's negative. Okay? That's how you calculate seasonal variation. Now, if you want to calculate average seasonal variation, you take from here. So because it starts from here, you take the number from the third quarter, 43, then again the number from the third quarter, 52, from 2012. Again, you take the number from the third quarter, 58. You add them up and divide by 3, you get 51.67. Then you take the number from 2011, you take this number from the fourth quarter, minus 20. Again, you take this number from the fourth quarter, minus 8.75. And then you have minus 17.5. It'll be minus 15.4. That's average seasonal variation. This is quite important because I feel for October, November, this will come, I feel. Or this may come. I don't predict questions, but this may come. Okay? So there we go. This is how you find the trend, the seasonal variation, and average seasonal variation. Please do practice it from the book. Okay? And then you can plot this number, trend, you can plot this on a line graph, and it'll show you that this is the trend. This many units you should produce, and this is going down, and again it's going up. So the trend, cyclical fluctuation, seasonal fluctuation helps you to predict the number of units. And when you know the number of units, you can manage your workforce, you can manage your finance, you can manage your administration, right? It's quite interesting. It's quite interesting. Now, the advantages are, different things, such as the advantages of moving averages are, seasonal variation, okay? Cyclical fluctuation, the random fluctuation, a lot of things in depth, which is not possible in the Delphi method or in normal methods like, Salesforce Composite. Here you're doing with calculation, so it's more specific. You can also do short-term forecast. What is going to happen in the next 3 months or 2 months? And it'll tell you about average seasonal variation. But the problem is, the first main problem is, it is a very complex calculation. As you can see, it's simple, but then it's complex, right? You have to spend a lot of time. It's time consuming, and not everyone can do it. You need to have specialist manager to do it, right? So there you go. There's no guarantee, because future becomes less accurate, because whatever figures you got, these are all based on past data. And past data does not guarantee success. There is no way that you can be successful. So, yeah. What else? External environments can change. Qualitative environments can change. And numbers will have no value. So what do you do then? right? So these are the advantages and disadvantages. You should know them properly. Yes, I will email you the slide as soon as I'm done. Um, and then you can also establish casual relationship. Now, with prediction, there is a relationship with price. Now, if your price is high, just think about it. If your price is high, then the demand may be less. It also depends on what kind of product it is. So there is a casual relationship with your price. It also depends on your competitor, on how they're doing, what is the promotional activity. It also depends on your workers. Are you paying them well? If you pay them well, then they will work properly. They will try to sell more items. It also depends on the income of the customers. If they have more income, they will buy the product. Otherwise, they will not. It also depends on the weather. Yes. So there is a casual relationship between these things: price of the product, income of the customer, competitors' product, competitors' promotional activity. So you also have to keep these things in mind while predicting the sales of your products in your company. Okay. So yeah, and again, but however, casual relationship, the problem is, there are other factors too. We've talked about this. Great, we have finished this chapter finally. I repeat it again because I was not happy with yesterday's class because of technical issue. The internet was down yesterday throughout the country. So there you go, we finished this. So four methods to predict sales: Salesforce Composite, the Delphi method, jury of experts, consumer surveys, and moving averages. Moving averages is more, has to do with calculation, right? Um, there we go. And again, you have correlation. You have to keep these things in mind. Great. We'll end this class here. Please do not hesitate to like our page on Facebook, subscribe to our page, Fyruz Education Services. You can also send me friend request on my personal page. It's not a fan page. And you can also subscribe our page on YouTube, Fyruz Education Services. Thank you very much. I will see you in the next class.